Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Phil Mackintosh, Chief Economist at Nasdaq, Brian Joyce, Managing Director on the Nasdaq Market Intelligence Desk, Jeff Kilburg, CNBC contributor, founder, and CEO of KKM Financial, and Kevin Pearly, founding partner of SkyPath Private Wealth. We're here to discuss how investors are approaching their portfolios among continued uncertainty with tariffs and broader policy initiatives. It's great to have all of you with us. Welcome back to Market Site. Jeff,
Thanks,
great to
Jill.
see you. Kevin, I'm going to kick it off with you. You're the one who was talking to retail clients, high net worth clients every day. And over the past couple of months, I'm sure the conversations have shifted quite a bit. How are they managing? How are you managing them?
They certainly have shifted quite a bit. I mean, if the last few years has been pretty easy to kind of make money in we'll call it the financial markets, April was extreme volatility. But it's volatility that we haven't seen before. If you think back to COVID, if you think back to the financial crisis, if you think back to all these other periods of time, the market has been dislocation and there has been big drawdowns. But that presents opportunity, not only for longer term investors, but for short term traders as well. So we use that time to reposition clients' portfolios, cash that's been sitting on the sidelines, getting them into longer term investments, as well as rebalancing the overall portfolio. But what we do is really tend to stay at the behavioral aspect for clients. Whenever there are periods of heightened volatility, people get nervous and they're asking questions. Is this time different from the past? We don't think it is. This is a dislocation that we'll get through. There is a 90-day pause like we talked about, and a lot can happen in 90 days. If you think about 90 days ago, the Super Bowl was 90 days. Most people don't even know who was in the Super Bowl, let alone maybe even what the score was. You know, they talk about 100 days during the summer, right? From Memorial Day to Labor Day. Granted, it's a little more than 90 days. By the end of the summer, people forgot what they did at July 4th. So the point there is, over a 90-day time frame, things will get worked out, and we think this is a great time to reposition portfolios for the longer term.
It's interesting because, Jeff, I think when you have recency bias where everything was by the dip mentality, right, and these periods of volatility weren't quite as long as they might have been now, and some investors just haven't been through a prolonged period of volatility. So I think there's some of that in there as well.
I think the game has changed, Jill. You're absolutely right. And you see zero-dated options being input there. You're seeing more and more leverage being utilized. But what's fascinating, Kevin brought it up, was that acute volatility. It felt different this time. But was it really different? The VIX went above 60, and all of a sudden we saw the markets really in peril. And that actually, the second day after the Rose Garden debacle, or whatever we want to name the Rose Garden presentation, that Friday was the most puts ever bought on the S&P 500, the most option activity. And then what did we see in the last 4 weeks? We saw the second largest crash in volatility with the VIX back under 25. So I think Kevin brings up a great point when you talk about behavioral. And that's why his clients have plans. That's why you have a plan going into it. It's just like playing a game. You have to stick to the plan. And when you saw that type of feeling, it did not feel good when we were repositioning. But we always know when we see that type of acute volatility, which was different in the way it was presented, because it was kind of self-inflicted. Right. That manner itself did provide opportunity, and now here we are seeing what's next. Are we going to get past this? Are we going to get something tangible in a trade deal? I think the markets will adhere to that, but right now, I know Brian's going to probably bring up some charts here. They'll probably make us, jump off the desk here a little bit at some point, but at the end of the day, we're at a pivotal moment, but we're kind of back to the starting line of 2025.
Yeah, well, before we pull up the charts, Phil, I want to go to you for a moment here. Let's use COVID as an example, more recent. It was identifiable. We knew what the issue was. We knew what the end game was. Here, it appears to be we're fighting fights on multiple fronts.
I mean, sort of. I kind of agree. All crises are different, but at the end of the day, it's uncertainty that really makes the market sell off. So with COVID, we all didn't know how long it was going to last, how many companies were going to shut down, whether we would have jobs in 6 months. Turned out it wasn't nearly as bad as we thought because humans managed to work through this thing. With this particular issue, it's same kind of problems. Is my company going to survive if the tariffs happen and we're going to have customers in 3 months and we're going to have a job? Probably what's going to happen is companies will work out how to change their supply chain. They'll work out how to make things in different countries or maybe build factories in America, and people will move jobs into places that are growing because of the tariffs. And all of a sudden, to your point, maybe it's not 100 days, but maybe in 3 or 4 years, we look back and we're like, yeah, that was kind of a blip. So I think there's some scenarios coming out now that are kind of positive if the tariffs are implemented, maybe not as aggressively as in the Rose Garden, but if tariffs are in place and the supply chains start to change, we're seeing in Europe, if they start to invest in themselves, invest in their defense industry, the defense industry started to outperform. In America, like there's a lot of companies that are local that are looking forward to having some protection, be able to grow their factories and grow their output. So some areas are going to be winners. And when everything went pear-shaped 3 weeks ago, was a lot of fear about the losers. But tariffs are going to benefit some people too.
Well, in fairness, I mean, the supply chain, either onshoring or friendly shoring, was happening even during Biden's administration. So it's not like it's a direct result of this, and there have been some plans that are in place already. But Brian, the shock factor, and I think your chart will illustrate it, more so than our talking points, if you bring up something more near term on the overall market as an example.
Yeah, so looking at the S&P 500, we had a 20% decline, high to low, give or take, about 1,160 points. We've rebounded now almost an exact 61.8% retracement. That was the high from last week. So this is where we expect now at a minimum, some backing and filling. That Fibonacci retracement is not the end-all be-all, but we could see it also coincides with the low from late October, and it also coincides with the 200-day moving average, which is right around 57.5, 57.50. So I think we have some expected technical resistance here at this level, and we'll see whether or not we can consolidate right around here. Hopefully we can, or if we're due for a deeper retracement, a little further back in price.
Yep, and we'll put bonds for a moment here too, and then Jeff, I'm going to have you comment on that as well. That seems to be the crux of the story as well, and the movement that we've seen as it relates to what's happening overall.
Sure. I mean, the 10-year to me is not the most exciting chart these days. We peaked back in October of 23, around 5%. In 24, we made two highs at 4.75, and now we're around about 4.25, 4.25%. So we're sort of in this, lower sideways trading range right now. Not really seeing any direction, up or down from here.
Yeah, but we did hear a lot about treasuries and how that could have been some insight in terms of how the rest of the world was perceiving what's happening.
And a couple of months ago, the Treasury talked about reducing the amount that they were going to run off, meaning that they're going to be back in the business of buying bonds, and we saw that this week. But what I think is fascinating, to Brian's point about the chart, is that when you see emotion be injected in the way it was, when you see the VIX go above 60, that emotion really kind of pushes me more towards the technicals, because when people get so bearish, there was people on TV claiming for a Black Monday, right? There were people calling for a 4,000 test in the S&P 500. So my point is that when you see that emotion injected, the technicals are so important. But remember, all these moves are going to be exaggerated to the downside and upside. That's what volatility is, Jill.
Yeah, I mean, just think about that 6-week time period within COVID. If you were to just have sold your portfolio at that point, that was almost a generational buy, if you will, even though we're saying that 3-4 years later at this juncture. But Kevin, I think, to Jeff's point, to come on and say, oh, this could be like another Black Monday, the structure of the market, the economy, our entire ecosystem is so different than back then. It's hard to make that apples to apples comparison.
It is very hard. However, when you think longer term, this will get worked out. One of the pieces we use with Jeff is his Essential 40. It's the 40 essential companies within the United States of America. United States will continue to thrive, and as we talked about before.
Which is listed at the Nasdaq, by the way, ticker ESN for those listening.
Yeah, companies will figure out the way to get through it. And as an individual investor, this provides an opportunity to know what you own, know why you own it, and have a bucketing type strategy. So if you need money in the next 1, 2, or 3 years, you probably shouldn't be invested in stocks at all. However, when you're looking out longer term, you should be. And I think when it talks about inflation, like we were talking about before, I mean, we're here in the center of New York City here. Broadway is right here. If anyone thinks the price of a Broadway ticket in 3, 5, and 10 years is going to be cheaper than it is today, I think they're mistaken. Yep. So you have to invest in assets. You have to invest long term. And the day-to-day noise, is for the traders.
Yeah, it certainly
But for
is.
us, we really have an investor client base.
And to your point about Times Square, if you look outside, even if you look at other travel metrics, it has not declined to the point that some analysts thought that it might, whether it's for geopolitical reasons or affordability reasons. I mean, there hasn't been that decline.
Restaurants are filled, airplanes are filled, hotels are filled. When will it end and when will it slow down? We'll soon see. But it's very hard to get into a restaurant in almost any major city right now.
Yeah. Let's go back to the methodology of the fund for a moment here with the 40 stocks. How active is that? How do you make those kinds of decisions of what's being held in a volatile market such as
So we
this?
have monthly investment committee meetings. We try to be more considerate on that longer term view and rebalance that annually. But when you see the rotation that we've seen, and we talked a lot about how the Mag 7 was overvalued in Q4 last year, even in Q1 this year. So when that Mag 7 got revalued, you saw the air come out of the balloon. So the fact of the matter is we've seen a big rotation into these essential stocks. When you think about names like CVS, you talk about IBM, no one really wanted to own Big Blue until they got involved in the cloud. So these are names that we really deem are critical to U.S. economy. It's a modern day version of the Dow Jones, and you're seeing more and more people rotate into those less sexy stocks. We still own 7 of the top 10 S&P 500 names, but when you talk about a name like Costco, you talk about a name like CVS, these are names that just typically don't get people excited about. But at the end of the day, you're seeing people move back into these blue chip tangible names.
Yeah, well, it doesn't freak them out either.
That's right.
Phil, question for you. With the demand that we continue to see, whether it's consumer, travel, and so forth, do you think some of that's being pulled forward?
Oh, absolutely. It's hard to tell with the chart right now whether the spike is because of everyone pulling things forward or whether it's actually something to do with the tariffs and people's fear of tariffs. And it's going to be worse next month, because if it was a pull forward spike, there's going to be a drawdown afterwards until things get back to normal. So the data right now, most of the economic data is still looking at March, which has nothing to do with April. Because we have the 90-day pause, I think even the April data might not be as impacted as we think, but there was a huge pull forward, and the current account deficit hit records. So huge pull forward of imports. A lot of drugs got put on planes just to get here before the tariffs. And that's going to mean that for the next month, we're not going to need to do that. And so there's going to be a lot of weird looking charts that have nothing to do with the economics.
It's kind of like the inverse of what we've seen with shelves during COVID, where now we might have too much supply.
Well, I mean, in a lot of ways these days when you look at charts too, people cut COVID off, right? Because things dropped so far that they literally went off the charts. And then the next month when they bounced back to what was normal, the growth rate was so strong, it literally went off the charts. And so a lot of charts now just pretend COVID didn't happen, because it was a drop down and come back, and then things kind of got back to normal. And we've seen huge amounts of bring forward imports. The impact, ironically, pulled down the GDP in America. So the whole conversation about our GDP going negative, it's really because of the imports. Europe had a strong GDP. Some Asian countries had strong GDPs for exactly the opposite reason, because they were exporting to us.
So you don't want to hear that headline about our deficit increasing?
Not yet.
That's not
yet.
Quite the optics that
I know that's the point of the tariffs, is to reduce the trade deficit.
Right.
And right now it's having the opposite effect, but that's because everyone's trying to bring forward things and save some money on tax.
Speaking of money, Brian, let's take a look at gold. I also want to take a look at the U.S. dollar to see how that, the U.S. dollar, of course, is going to impact how you're thinking about pricing and traveling and your input costs and so forth.
Sure. So dollar right now is trading at 2-year lows around the, this is the DXY, around 99.5 to 100. So that's been a clearly defined support level, lows in 23 and throughout 2024. The range there is about 7 points. So I think if we have a breakdown below that support, technicians will project basically a downside target of around the 92.5 to 93 area. So that, I would think, for the globe would probably be a bit of a tailwind, particularly for emerging market stocks and larger U.S. corporations.
And of course, we have to look at gold as well. We understand the reasons why there was the bid there, of course, but that was in there, even since last Q4 of 2024. That was a key story. Sure.
Gold, in my opinion, last year in March had its big breakout above that range, which wasn't just from the prior 2 years, but you can really go back to 2011. So it was about a 13-year sideways range where gold had made its breakout from last year. It's up about 55% from last year's breakout level. So certainly very constructive. I think near term, anything is certainly possible. We could see, a pullback of at least 10-15% magnitude, and still the charts longer term would be looking quite constructive.
Yeah.
So,
Phil, one more question as it relates to the global economy. Even if we do get a resolution, let's call it within the next 100 days, do you think that the global trade infrastructure has shifted, or it will continue to shift, or we're not trusted anymore, if you will?
Yeah, there's two separate questions there. I think the more interesting question now is what will the resolution of tariffs be?
Right.
And I guess with the pause, maybe something closer to what the campaign promise was, which was 10% across the board, might be where we fall. And I think a lot of companies could probably absorb most of a 10%. Right. Maybe prices go up a little bit, but you'll over time then move your production around and refactor, maybe bring some jobs back and reshore in America, but then also other countries might have retaliatory tariffs, and you sort of unfriendshore if you want. That to me is a more plausible outcome at the end of 90 days. I think if we get to the end of 90 days and we go back to the Rose Garden rates, that's going to be scary for the markets, and we'll probably see a lot more uncertainty. And having talked to companies straight after that announcement, the companies didn't know like whether they should invest, whether they need to hire in America or move production overseas, because they didn't know what the retaliatory tariffs were going to be like. And countries are going to defend their own industries too. So,
Right. Well,
Can I ask a quick question? We're treated with our economists here, the Nasdaq. But when you talk about all different scenarios being priced in, right? Companies uncertain, so they're buying back their own stock. Big theme in Q1 earnings. But what happens if those tariffs that we expect to go to 10%? What if the art of the deal actually is President Trump is just trying to sell LNG, soybeans, and corn, and some country can go from 10% to zero if they commit to buy X amount of our products. Is that a tailwind? I mean, I know Kevin's, a lot of his high net worth clients aren't really slowing down, but they're uncertain. But is that a tailwind that potentially takes us up and over Brian's charts, up to new highs?
I think if we heard that specific news story, it would be a tailwind, because the implication for the markets, because we extrapolate everything, would be, oh, that's a pretty good deal. It's workable, and companies will be able to invest and plan based on that. And it's not nearly as scary as the Rose Garden proposal. So I think that would be a tailwind for all countries, because then you'd have a roadmap to negotiate and also an outcome that's not going to hurt companies with inputs coming from overseas and pieces in their production chain that are from overseas.
It almost makes you wonder, if you do get the 10% scenario, or perfect case scenario such as yours, was all of this drama worth it? Or perhaps did we learn something from it in terms of how we have to plan for multiple scenarios?
I think Kevin's receptionist would probably say no, because they had a lot of incoming phone calls from their high net worth clients.
Yeah.
But I think this was just poorly executed.
Right.
Is the idea of rebalancing and leveling the playing field? Of course, it's been decades and decades. You can blame both sides of the aisle for that problem. But at the end of the day, the execution was just atrocious.
Yeah. Well,
and I would also say, we'll see how it all shakes out. But I think what we will learn from the behavioral aspect from the individual investor is you have to stay committed. And you can't jump in and out. By jumping in and out, you got to be right twice. One on the sell and the other on the buy. And history has always shown staying invested, staying diversified, and that behavioral aspect will give you financial success. So that's what we're looking to do with our clients, to keep them committed to the goal. If they don't need the money within the near term, stay committed, stay balanced, and stay positive.
all right, and we'll end it on a positive note. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.